The global economy runs on a set of quiet assumptions. One of the most important is that the world's major trade routes remain open and uninterrupted. But what happens if one of the most critical arteries of the global energy system suddenly stops working? Today we are looking at the Strait of Hormuz, a narrow waterway connecting the Persian Gulf to the Gulf of Oman and the open ocean. On a map it looks small, but economically it is one of the most important choke points in the world. In this video we are not focusing on military drama or political rhetoric. Instead, we are examining the economic consequences. What happens to energy markets, supply chains, inflation, and financial markets if the Strait of Hormuz is suddenly blocked? To understand the scale of this risk, we first need to understand the mathematics behind global energy flows. The Strait of Hormuz may be geographically narrow, but economically it is enormous. Roughly 20% of the world's daily oil supply passes through this single maritime corridor. Every day, millions of barrels of crude oil move through this narrow channel on their way to Asia, Europe, and global markets. This is not a volume that can easily be replaced. Strategic reserves exist, but they are designed for temporary disruptions, not a structural loss of 1/5 of global supply. If the Strait of Hormuz were closed, energy markets would immediately face one of the largest supply shocks in modern history. But the vulnerability goes beyond crude oil. The Persian Gulf is also one of the world's most important centers for natural gas exports. Qatar, one of the largest LNG exporters on the planet, ships a significant portion of its liquefied natural gas through this same corridor. If shipping through the strait stops, those LNG exports stop as well. That means global markets are not just losing oil. They are losing a major source of natural gas at the same time. This kind of simultaneous disruption would test the energy security of industrial economies around the world. The economic impact of a Hormuz blockade would not be evenly distributed. Some regions are far more exposed than others. Asia would likely face the most immediate pressure. China, the world's second largest economy and one of the largest energy importers, relies heavily on oil shipped from the Persian Gulf. A disruption in this corridor would immediately raise energy costs for Chinese manufacturing and industry. Higher input costs would ripple through supply chains, affecting everything from industrial production to export competitiveness. For a manufacturing-driven economy, energy stability is a critical foundation. India faces similar vulnerabilities. Emerging economies tend to be extremely sensitive to both high energy prices and a strong US dollar. If oil prices spike, emerging markets often experience currency pressure, rising inflation, and capital outflows. Higher fuel costs quickly spread into food prices, transportation costs, and everyday household expenses. For large emerging economies, this kind of energy shock can create serious macroeconomic stress. Europe faces its own set of risks. While crude oil disruptions often dominate headlines, the halt of Qatari LNG shipments could be equally damaging. European energy markets are already under strain after losing much of their Russian gas supply in recent years. A sudden loss of LNG from the Persian Gulf would tighten global gas markets even further, forcing Europe to compete aggressively for alternative supplies and driving prices higher. So how does a disruption in a narrow waterway turn into a global economic shock? The transmission mechanism is surprisingly direct. First, shipping stops. Tankers inside the Persian Gulf are warned not to leave, and vessels approaching the region are diverted. At the same time, maritime insurance companies dramatically increase risk premiums. Ships operating near conflict zones face extremely high insurance costs. These costs are quickly passed through the global shipping network. Then energy markets react. Oil benchmarks such as Brent crude rapidly reprice as traders attempt to calculate the scale of the supply disruption. Higher crude prices quickly translate into higher fuel prices. Gasoline and diesel costs begin to rise, and that increase spreads through the entire economy. Transportation becomes more expensive. Airlines face higher fuel costs. Shipping companies raise freight prices. Manufacturers pay more for raw materials and logistics. For many businesses, fuel is a core input cost. When energy prices spike, corporate margins shrink. If companies cannot pass those costs on to consumers, profitability suffers. If companies do pass those costs on, consumers begin to feel the pressure. This is where the economic shock reaches households. Higher gasoline prices act almost like a tax on consumers. Families must spend more money simply to commute, travel, and heat their homes. When energy costs rise, households often cut back on discretionary spending. Retail purchases slow down. Services see reduced demand. Economic growth begins to weaken. At the same time, food prices often rise because transportation and agricultural production depend heavily on fuel. This creates a serious challenge for central banks. Historically, energy shocks have triggered periods of stagflation, a difficult combination of rising inflation and slowing economic growth. Central banks normally respond to weak growth by cutting interest rates. But if inflation rises at the same time, their options become limited. A prolonged energy shock could force central banks to keep interest rates higher for longer. That means higher borrowing costs for businesses, higher mortgage rates for households, and tighter financial conditions across the economy. Financial markets tend to react quickly to these kinds of risks. Energy markets often spike first as traders anticipate supply shortages. Oil prices can rise sharply as markets attempt to balance supply and demand. At the same time, investors often move money toward safer assets. Gold typically sees strong demand during periods of geopolitical uncertainty. Government bonds can also experience volatility as investors reassess inflation and interest rate expectations. Certain sectors of the economy may benefit from higher energy prices. Domestic oil producers in countries like the United States could see stronger revenues as global buyers look for alternative suppliers. But for many industries, especially transportation, logistics, and heavy manufacturing, higher fuel costs represent a serious challenge. A common question is whether alternative routes could replace the Strait of Hormuz. In reality, the answer is largely no. Some pipelines exist that bypass the strait, allowing limited volumes of oil to move toward the Red Sea. However, these pipelines can only transport a small fraction of the total oil that normally moves through the strait. The geographic reality is simple. A massive portion of global energy trade relies on this narrow corridor. If the strait is closed, most of that energy simply cannot move. Looking beyond the immediate shock, a prolonged disruption would likely accelerate long-term changes in the global economy. Companies may begin shifting supply chains to reduce dependence on vulnerable trade routes. Governments may invest more heavily in energy diversification and strategic reserves. Countries may also increase defense spending to secure key maritime corridors and critical infrastructure. These adjustments take years and require enormous investment. In the short term, the global economy would still need to absorb the immediate shock. In the end, the Strait of Hormuz is not just a line on a map. Economically, it is one of the most important pressure points in the global system. Every day, roughly 1/5 of the world's oil flows through this corridor. When that flow is stable, global markets function normally. But when that flow is threatened, the consequences spread quickly across energy markets, supply chains, and financial systems. Oil prices rise, transportation costs increase, corporate margins tighten, consumers feel the pressure through higher fuel and food prices. For central banks, it creates a difficult choice between fighting inflation and supporting economic growth. And for global markets, it is a reminder that modern economies depend heavily on a few critical trade routes. In today's interconnected world, conflicts are not only fought with weapons. They are also fought through supply chains, shipping lanes, and energy markets. And sometimes the most important battlefield in the global economy is a narrow waterway that most people rarely think about. If you want more clear economic analysis of global events like this, subscribe to Economic Times now. And one important question for you. If the Strait of Hormuz were closed even for a few weeks, do you think the global economy could absorb the shock, or would energy markets spiral out of control? Let me know your view in the comments.